It is February the 15th. Michael Vaughn with Brian Acker. And Brian, the last time I saw you was December the 22nd. We knew a correction was coming in 2018, and it came right at the end of the year.
Yeah, it was amazing. Actually, I thought something systemic happened because it was brutal. It was a sell-off.
For Deutsche Bank to blow up or something.
I was expecting the same thing, but obviously since then we've rallied considerably. So I mean, who's to say what's going to happen? But
it was a terrible December. The year wasn't that bad.
It wasn't that bad, but just on our returns for 2018, just to put that to bed, looks like the U.S. Value 50 fund was down maybe between 1.9 and just over a percentage point.
Thank you, December.
Yeah, but the S&P total return index in Canadian dollars ended up at 4%. Yep. So we ended up underperforming there. The Canadian, I mean, we're much in line with the TSX. So the S&P TSX composite total return for the year was down 8.89, and we were down 8.35. Yeah. So we were.
Well, how much are we back? I mean, we're 6 weeks into the year.
So
the numbers are.
Yeah, the Canada Focus is almost up 10% so far in Canada. And the U.S., we're just over 6%, with the S&P just a tad bit higher, but not much. So,
but it does feel like a shallow recession, at least, is coming on. but we didn't have the disaster that people saw coming.
Look, I think what caused December, the market was certainly in a bad mood about the Federal Reserve.
Yep.
Jerome Powell came out with the standard press conference, and the market was having nothing of it. So, interesting enough,
Trump went ballistic.
Yeah, Trump went ballistic. Kudlow went ballistic.
Yeah.
So, at the end of the day, he's walked back every single word that he said in mid-December. So
no more rate hikes. But what about the quantitative tightening? Are they still selling off?
Well, just yesterday, a governor came out and said she wants to stop QT.
Oh.
So quantitative tightening. So look, I think 2019 is going to set up as the year of the central bank.
Oh.
So the economy is going to do whatever it's going to do. Certainly consensus is we're going to have a recession. We're going into a global recession.
Which might not be bad.
Well, the hard part is to determine what malinvestment there is out there.
Yeah.
So I think central bankers, policymakers, they're all quite worried here. What happens if we do have a slowdown, A, with all the debt, B, what response the government is going to do to, so, usually if a garden variety of recession comes along, what do? You lower interest rates, you ease monetary policy, maybe have deficit spending in terms of fiscal policy.
They've got that.
The U.S. has, for sure. So that's the playbook. Yeah. But with rates so low and with government debt levels so high, the question has to be asked, well, what sort of ammunition do you have as a central bank to compound, to correct a recession, if you will? But look, we need a recession. We need to test, if you will, the asset values that we actually see today, that we're trying to participate in a functioning economy where people are buying and selling at certain prices. So a recession would make a lot of sense here, just to calm everything down. Let all the asset bubbles deflate, if indeed there are bubbles out there, and get us off on a normal footing. But
you say the year of the central bank, they're going to throw everything but the kitchen sink at it.
Absolutely,
to keep the party running.
Yeah, and look, so what we just saw, literally in the last 2.5-3 months, was a central bank hard line.
Yeah.
the market reacted, and now basically the central bank has walked everything back in terms of that. And keep in mind, Europe, they're not doing QT as yet. They're just doing nothing. They're not, they're not aggressively buying assets. They're just letting the interest accumulate. And of course, Japan is full force quantitative easing. Of course, the big unknown here is China. What is going on over in China? So they rival the United States in terms of economic power.
Well, at least they're still talking. The talks haven't blown up.
Yeah, but I mean, what is going on over there now? There are actually two companies, a big Chinese companies who came out this week, and they've haven't paid their interest on their bonds. So, and there's basically they're state-run lending organizations. So, and again, it's
which you've often said is the biggest credit bubble in history
since man's been on this planet. So what will happen is, I don't know, but whatever bad thing does happen and the markets respond to that, look for the central banks to come in and do more and more. So I think 2019 is going to be like that. And if you make a decision on your asset allocation, if we get to the bottom like we did in December, and you adjust your asset allocation because you become worried or whatever, we've seen nothing but up days since that day. So you've got to be very, very careful in adjusting your asset allocation and stuff during these downdrafts. But that's the market we're going to have for quite a while until visibility gets quite a bit better.
Well, the American consumer hasn't panicked yet.
No, and keep in mind, I think the American consumer is in good shape. Just they haven't really gone on a spending spree, if you will, since 2008. So yeah, I think the consumer is in good shape in the U.S. But again, what does the future hold? It's very uncertain. Certainly looking at March, I mean, we got Brexit, we have this trade deadline, which is penciled in at March 1st. So we're going to have lots of volatility and lots of response from policymakers. So enjoy the tranquility of this market that we've had. There's probably going to be at least one, if not two more roller coaster rides for 2019.
Well, the ride continues. Brian, thanks for your time. I'll be in to see you in March.
Michael, always a pleasure to see you. Thank you.